Welcome to our class on stock market investing or investing in stocks. What we're going to go over is a few more concepts in stocks, stock exchanges, understanding what stock exchanges are, calculating your returns from investing in stocks, and a few more concepts. With that being said, let's get started. Here are a few concepts and definitions that you want to familiarize yourself with. Stock exchanges are institutions that allow you or allow investors to exchange established stocks. There are a couple of different types of traders. There are floor traders, who are traders who perform exchanges at stock exchanges, meaning they actually sit on the floor and call out numbers for trades for their clients and whatnot. There are also specialists. Specialists are traders who are willing to buy when you want to sell and are holding on to stocks, and they'd be willing to sell to you in the event that you wanted to purchase a stock. There are also market makers, who are traders who execute trades on an over-the-counter market or an OTC market and earn commissions in the form of a bid-ask spread, which is simply the difference between what one is willing to sell for and what one is willing to buy for. Executing a transaction. Today's time, most transactions are done over the internet. So there's a plethora of the platforms that you can use to execute these transactions: Ameritrade, Scottrade, Fidelity. There's a ton of them out there. These platforms, in many cases, offer free online education on how to use their platform. They use real life timing or live timing so that you can get a feel of how to transact or execute trades online before you even getting started in actually investing. There are two types of brokerage firms that we're going to look at here: a discount brokerage firm and a full service brokerage firm. The fundamental difference, without going into too much detail, is simply that a full service brokerage firm offers investment advice along with executing transactions for you, where a discount brokerage firm does not. A quick note, investment advice does have its limitations. There have been studies to show that investors on average do not perform better than industry indexes in most cases. Investors also could have a conflict of interest in when you want to buy or sell, because they could have obligations to a friend that owns a company or is the CEO of a company, or they could have a conflict of interest because they're being paid commission every time you execute a trade, whether it's buying or selling. Here are a couple of terms that you want to familiarize yourself with for buying and selling online, which is pretty much the norm now. You want to become familiar with the ticker symbol or the name of the stock, which is the abbreviated term that identifies the stock on trading platforms. Whether you're buying or selling, you want to become familiar with the idea of round lot, which are shares bought or sold in multiples of 100, and an odd lot are shares that are bought in quantities of less than 100 shares. A couple of other definitions: a market order. It's an order to execute a transaction to buy or sell a stock at its prevailing market price. A limit order is an order to execute a transaction to buy or sell a stock only if the price is within the limits that you specify. A stop order is an order to execute a transaction when the stock price reaches a specified level. A buy stop order is an order for a brokerage firm to buy a stock when the price rises to a specified level. And a sell stop order is an order for a brokerage firm to sell a stock when it falls below a certain level. And on the next slide, there's going to be a Scottrade screenshot example of all of these things consolidated into one, so you can understand it a little bit better of what it looks like on an online platform. Here you have buy sell at the top, the number of shares. Right next to the number of shares, there's something that says AON, which means all or nothing. So when you click on that button, that means that you want to buy all shares at this particular price, or you're not going to buy them at all. Order type, again, we went over a couple of these concepts in the last slide. You have limit order, stop, stop limit, trailing stop. Again, most of these platforms do have the opportunity for you to have free trials to go through and educate yourself on your own for free. Buying on a margin is another concept you want to become familiar with. What buying on a margin is, it's basically lending from the brokerage firm to purchase stocks. The limit right now, according to the Federal Reserve, is 50%. So an example is, if you purchased $100,000 worth of stocks, you can borrow $50,000 if you're putting up $50,000 yourself. And another concept is a margin call, which is the request from a firm for the investor to increase the cash in an account in order to bring the margin back to the minimum level. So basically, if your stock declines in value, what you may have to do is put more money into the account so that you can maintain that level for buying on the margin. Here I'm showing you a equation for returns on buying on a margin. The variables in there are the proceeds from selling, which is abbreviated as SP. D stands for dividends. I stands for the cash investment, and LP stands for the loan payment, which is the amount paid to the brokerage firm for the loan that you have taken out, multiplied by the interest rates on that particular loan. So LP, or the loan payment, is the loan times the interest rate. And at the top, the equation is return equals proceeds from selling plus dividends minus the cash investment minus the loan payment divided by the cash investment. And on the next slide, so it becomes more understandable, I'm actually going to show an example. Here's an example of a gain. Again, the equation that we saw on the last slide. Here we're going to put in $10,000 being the proceeds from the sale, plus $200, which is the dividend, minus $6,000, which was the initial investment that you put into the stock, minus $1,150, because what you did was you borrowed $1,000 to invest in the stocks, and you got hit with interest on that particular stock. So you divide it by 6,000 again, which is the initial investment, cash investment that you put up, and your return is 51%. And if you want to see how this is making out better than personally investing all of your cash, you would look at the example below, which this is someone putting their own $7,000 as opposed to putting $6,000 in and then borrowing $1,000. So again, the proceeds from the sale is $10,000 plus $200 in dividends minus $7,000, which was your cash investment, divided by $7,000, and not from $6,000, because in the first equation, again, although you invested $7,000, only $6,000 was your cash investment. And your return for this case is 45%. Now, one thing you want to note is you get bigger returns if you gain while investing on the margin, but your losses are also bigger when you invest on the margin. And here is an example of investing in the margin and having a loss. So your proceeds from sales is $6,000 plus $200 in dividends, when your personal cash investment was $6,000, and you borrowed an additional $1,000. So $6,000 plus $200 minus $7,150 divided by $6,000, which is your cash investment, your return is negative 15%. And below, we're showing you having a loss without investing on the margin or borrowing on the margin. If your investment or your proceeds is $6,000 and your cash investment was $7,000 as opposed to borrowing an additional $1,000 after your $6,000, your return is actually only negative, or your return is a negative 11% as opposed to a negative 15% with buying on the margin. And if you want to gauge your performance and how well your particular investment is doing, what you can do is you can pair your return with the returns of a stock index or the index in a particular industry. And the excess return, which is calculated as your investment return minus the stock index return, gives you a measure of how well your stock is doing. And below what I have here is a chart for you to look at. Let's say in year one, your return on your investments was 9%, while the stock index was 4%. Your excess return is 5%, which means that you're doing well in comparison to an industry index. While in year two, your return's 5%, but the stock index for that industry has gone up to 6%. So your excess return is negative 1%. Now, what does that mean for you? In simple terms, what that means is you would have been better off investing in a stock index as opposed to investing in a particular firm or company, because you would have had an extra percentage of returns. I know that towards the end of a few of the slides, my voice kind of... with that being said, thanks for listening in. I look forward to hearing and listening to you and getting feedback from you in the next video as well on Introduction to Bonds. Take care. Have a good evening.